Welcome to the Universal Accounting Center's accounting course with your accounting instructor, Alan Bostrom. Session 1, Essentials of Small Business Accounting. In this session, you'll become experienced in the common types of journals, including the Purchases Journal, the Cash Disbursements Journal, Sales Journal, the Cash Receipts Journal, Payroll Journal, General Journal, and the Standard Entries Journal. Additionally, you'll understand invoice coding, purchase order systems, payroll, and where to turn for answers to your payroll questions, and many more valuable tips to use when working with small businesses. Now, to begin this session, turn to page 1.3. Here's your instructor, Alan Bostrom.
Today we're going to begin working with a company called Artistic Furniture. We're going to work with several different journals that Artistic Furniture uses. Now, we've got to understand, first of all, the role of journals. Last week, we discussed what a journal was, and it had an alternative name. Does anyone remember what that name is? Yeah, Kathy? The original book of entry. You're just as close as I am, okay? But it's where we originally enter the accounting system. Now, the last couple sessions we've had, we have been using T accounts to enter transactions in, right? I gave you a list of transactions. You entered them into T accounts. Each of those T accounts represented the general ledger, okay? And so we were entering transactions directly into the general ledger when we were doing that. We were bypassing journals altogether, just going in the general ledger. Could we keep a set of books that way? Could we? Yeah, we could. I have done it before. Oftentimes when I'm working taxes for a client, they will bring in very summarized transactions, lists of transactions. And I might only have 24, 25 different transactions on this list. I'll just, rather than set up a whole set of books, just create T accounts on a sheet of paper. I'll have one paper for assets, one paper for liabilities, and so on, so that I can add T accounts as I'm going, as I see a need for them. And I'll do the full double entry process using T accounts. And it's faster than just going through and doing all the paperwork and so forth. You see that? But why don't we do that then on a regular basis? Well, I'll tell you. How many of you were out of balance at least once during the last couple sessions? At least once. Okay, we all were, I think. Maybe someone was lucky and didn't have, but most everybody was out of balance. And oftentimes, what was it? It was the math. Sometimes it was, you may have transposed numbers, right? Now, when you were out of balance, what did you have to do to find out where you were wrong? Start all over. Go back to every transaction. Now, that was only with 10 or 20 transactions. Imagine if you had 400 transactions and you had entered them all in. What are the chances that you would be out of balance at the end of those 400 transactions? Very high. In fact, I would expect every one of us, including myself, would be out of balance because we just make a mistake someplace. And what would we have to do to figure out where? Go through every single one of them. So the journals have a lot of purposes, and one is to ensure that the transactions balance before we move on. Okay? Now there's three primary reasons for the journals. One is to balance. Second is to simplify the data entry process. See, when you were doing debits and credits, you had to understand debits and credits, didn't you? But a lot of people that enter transactions into journals don't. They're just told, take this number and put it here, and this number and put it here. When I first started doing accounting, my father had me do the data entry part. And we had things just like these. These were post binder systems, and we had these. And he said, here's a sample of a journal. And he said, all I want you to do, Alan, is I want you to write in the amount of the check here, and the number of the check, and the date, and who it's to. Hey, anybody can do that. A monkey can handle that today, okay? And then I want you to write it in the column here. If it says on the check stub advertising expense, find the column that says advertising expense and write the amount in there. No one had to tell me that this side was credits and this side was debits, right? And I did pretty well with it. I added up the columns and I made sure that the side of this equaled this total here. So I, in essence, made sure that the credits on this side equaled the debits over here before I moved on. It makes it a much simpler tool. You see that? Now, the other thing that a journal does for us that the T accounts don't is to document. Okay? It documents the transactions. When you recall the T accounts, we didn't have any other information unless maybe you put a cross-referencing number, right? Whereas the journals document the check number and who it's to and the date and all the additional information that will be helpful if you ever have to go back in and research that problem. So they have three purposes. Could you use the T accounts? Yes, you could. Is it practical to use the T accounts? Only if there's very few transactions. Okay? A lot of transactions or normal number of transactions, you're going to use a journalizing system first. Now this looks a lot different than doing it on computer. Some of you who've worked on computer before, and instead of having columns and rows, it might look like a check on the screen, and you're filling in the blank spaces of the check. And it's taking that information in, and it's putting it in this format. It's assigning it debits or credits based on what you wrote in on that check. It knows that every check is going to do what to the bank? Or credit it, right? Every check, and it automatically assumes whatever you write that check for, it's going to credit the bank. And then you're going to have to someplace write in on that check another account, what it's for, advertising expense or rent expense or inventory, whatever, right? And that is going to be a debit to whatever account you put in there, okay? So it's just taking that information and assuming, and it's making it so that anybody can do the data entry, right? That has a knowledge of what accounts to use, and that's a big problem I find, you know. If you don't know what account to use, if you buy some staples to use in the office, yeah, and you think it's inventory, you know, because you keep an office supply inventory. Have you heard people refer to office supply inventory? And so you think, oh, it's inventory, and stick it in there. Or a lot of you struggled initially with this idea of advertising expense or utilities being accounts payable, right? And so people will go in and they'll write a check for utilities without first showing it in the system as an accounts payable, and they'll charge it to accounts payable. We ran into a situation like this with QuickBooks not too long ago. A lady had hired a person who said she was very qualified in QuickBooks. And she had, every time she bought inventory, she would debit accounts payable with it, but she never showed that she bought it in the first place, okay? So she was debiting accounts payable every time without ever recognizing that she first had to charge inventory. So she had a huge debit balance in accounts payable, and because they had sold the inventory, she had a huge credit balance in inventory. Can you do that? Credit balance in inventory, is that good? That means you sold things you never had, you know? And I know a lot of people have tried doing that before, but it's not legal, okay? So her accounting didn't reflect what was really happening. So people sometimes don't understand the other processes go on. Well, let's go through and understand, first of all, the chart of accounts for artistic furniture. And if you will look at page 1.3, you'll see the artistic furniture chart of accounts. Page 1.3, as you can tell, has the traditional accounts as well as some of the more specialized accounts for artistic furniture. We have the current assets, property, plant, and equipment shown down the left-hand side, and then below that are the current liabilities and long-term liabilities and capital accounts, okay? Now, the first two sections, current assets and property, plant, and equipment, are they debits or credits? Debits. Underneath that, current liabilities, long-term liabilities, and capital, debits or credits? Credits. Now, I want to point out one thing to you, though. Look under the current assets, Look at account number 225. What section was that account in before? The accrual. It was a markdown account. Oftentimes, however, today, we will actually blend in those accrual accounts with the asset that they pertain to. Now, in the accrual section, were they debits or credits? Credit balance accounts, right? What do you think they are when they blend in with the assets? Now, be careful. They're still credit balance accounts. They are called contra asset accounts when they're blended in with the assets. Contra asset accounts, and that means that they carry a credit which is contrary to the debit that assets usually carry. Okay? So they're contra asset accounts. They are asset accounts that have a credit balance. And if you look down into property, plant, and equipment, look at that second line. Account 285 is accumulated depreciation equipment, right? Contra asset account. Now, as a credit in the asset section, what is it going to do to the assets? It's going to decrease it. So the reason why we do that is for readability. It puts the markdown account right below the account that it's marking down so that you can quickly calculate what the book value is. You don't have to look at two separate sections to come up with that. You can just make a quick math, do some quick math and figure out what the book value is of it. Okay? Now that's very commonly the way you'll see it shown out there in the real world. And you'll see it that way. You'll see it both ways throughout our practice sets. Okay. Now let's look at some of the other things. What type of legal structure is this business? Sole proprietorship. Okay? How did you know that? Joanna, how did you know that?
It says owner's equity. So
that's right. It says owner's equity. What would you expect if it were partnership?
say partner 1, partner 2.
Yeah, it would show multiple equity accounts, right? And certainly it doesn't look anything like a corporation, does it? When you're saying that, because you got owner's draw and corporations don't have owner's draw. Why don't we have an earnings account down there, do you think? No, not because it's a corporate, because it's broken out on the right-hand side of this sheet, okay? So all the earnings sub-accounts are listed down the right-hand side. We have several different sales accounts. We have several different cost of sales accounts. And then we have many different expenses, okay?